I want you to picture a scenario you probably know a little too well. So it's Monday morning, you're barely awake, haven't even brushed your teeth yet, but your hand just instinctively reaches for that smartphone on the nightstand.
Oh, yeah. We've all been there.
Right. You load up your brokerage app, the screen refreshes, and you just let out this heavy, soul-crushing sigh at an absolute sea of red.
It's awful. It triggers this immediate physiological response. I
Yeah.
mean, your cortisol spikes before you even had a drop of coffee.
Exactly.
The screen is glowing red like a biohazard warning. And that basically just sets the tone for your entire day.
And then begins the frantic, desperate routine of the retail investor. You start doom scrolling financial news websites looking for some rational explanation. You open up your Discord servers or those 5,000 member group chats.
Hunting for the insider scoop, right?
Yep. You pull up the charts drawing these chaotic support and resistance lines, slapping on Fibonacci retracements until your screen looks like a spider web drawn by a highly caffeinated kindergartner.
Which is, frankly, an incredibly exhausting way to interact with the global economy. All that frantic effort is driven by raw emotion, intuition, and whatever fleeting rumors are circulating that morning.
And the result? You buy, it instantly drops. You panic, you sell to cut your losses, and the thing immediately spikes to an all-time high.
Yeah, that emotional volatility is precisely what we are unpacking in our deep dive today. We've gathered this really fascinating stack of sources: historical financial reports, dense quantitative academic papers, and a really detailed biography.
And the mission here is to track down one specific guy, a man who looked at that chaotic, emotionally driven market we just described, totally ignored it, and built the greatest money-making machine in human history.
The numbers attached to this machine are they're difficult to fully comprehend. To put it in perspective for you, if you had handed this man $100 to invest in 1988, by 2018, that single $100 bill would have compounded into nearly $400 million.
Wait, 400 million from 100 bucks?
Yeah. His name was Jim Simons. Through his Renaissance Technologies Medallion Fund, he generated an average annual return of 66%.
Wow.
And that's before fees, for over 30 years. I mean, that track record fundamentally shatters the achievements of every legendary value investor on Wall Street. While the rest of us brag about a 5% gain, he was doing 66.
And the ultimate irony buried in all these sources is that Simons was not even a finance guru. He didn't come from a long line of investment bankers.
No, his background is the complete antithesis of a standard hedge fund manager. He was actually a top-tier theoretical mathematician.
Right.
We're talking about a Berkeley PhD who spent the Cold War working as a codebreaker for the NSA. He was literally hunting for patterns in encrypted Soviet data.
That is wild.
He even won one of the most prestigious prizes in geometry. But then, right around age 40, he just abruptly leaves academia to trade stocks.
But see, you'd think a certified code-breaking genius would come in and immediately build a supercomputer, right? But the sources show he initially traded exactly like that anxious retail investor checking their phone in bed.
He really did. He fell into the exact same behavioral traps that plague everyone else. He traded on gut feelings. He panicked over the news cycle. He just scaled those traps up to an industrial level.
Yeah, the lengths he went to for an edge on the news were almost comical. Like, he hired translators to convert European financial news from French to English just a fraction of a second faster.
Exactly. He brought on Alan Greenspan as a private consultant before Greenspan even chaired the Fed. He literally had a cinematic, direct line, red phone on his desk for breaking global news.
Which leads right into the 1979 potato futures disaster. I was reading that, and it really highlights the absurdity of his early approach.
Oh, the potato incident.
Yeah. He didn't just take a bad position. He essentially tried to corner the entire main potato market without even realizing what he was doing.
He was buying so many contracts that the SEC had to personally intervene. They called him and forced him to liquidate his positions just to prevent a total market collapse.
But how does a genius fall into that trap? It's like a grandmaster chess player losing at tic-tac-toe because they insist on playing blindfolded.
Well, Simons openly admitted later that he lacked any fundamental understanding of agricultural supply-side economics. He didn't understand the physical reality of the potato crop.
He was just staring at the price, right?
Right, just staring at the price movement, feeling the adrenaline, and hoping it would go up. High IQ does not immune you from the emotional pitfalls of the market.
Right, if you're playing a game of intuition and hope, the market will crush you, whether you break Russian ciphers or work at a hardware store.
Exactly. And that near disaster forced a profound psychological reset for him. He realized that trying to predict human behavior and trading on the emotional whiplash of the news was physically destroying him.
So he made a radical pivot. He abandoned the Wall Street playbook entirely and went back to the only thing he truly trusted: pure mathematics and pattern recognition.
Right. He decided to treat the entire global market not as a collection of companies, but as a giant encrypted code. And to break a code, you need massive amounts of historical data.
Which, in the early 1980s, was kind of a wild idea. The prevailing theory then was the efficient market hypothesis, meaning all known info is perfectly priced in.
But Simons completely rejected that. He believed the market was structurally inefficient. He hypothesized that buried beneath the chaotic daily price movements, there were microscopic repeating patterns.
So his team started hoarding data. They bought up 10 years' worth of historical price data on magnetic tapes and graph paper.
Stuff the rest of the financial sector viewed as entirely useless garbage.
But once they had the data, they needed a way to actually read it. And they found that in early speech recognition technology. He brought in mathematicians who were pioneering the first algorithms to recognize human speech.
Yeah, and the sources have a great way to explain this. Imagine standing in a colossal sports stadium, tens of thousands of screaming fans, and somewhere in the center of that chaos, a single person is playing a violin.
Okay, I can picture that.
Traditional investors are in the stands trying to figure out what song the violinist is playing by watching the crowd's reaction. They monitor the cheers, the panic, the sentiment.
Which is exactly like trading based on earnings reports and CEO interviews. You're just analyzing the noise.
Precisely. But Simon's speech recognition algorithms did something entirely different. They didn't analyze the crowd. The math simply muted the crowd.
Wow.
It stripped away all that ambient acoustic garbage, the rumors, the panic selling, the news cycle, to mathematically isolate the pure signal of the violin.
So applying that to the stock market, they could isolate the pure signal of repeating price patterns, and that breakthrough birthed this radical philosophy at the fund. The why simply does not matter.
Right. In traditional finance, analysts spend their whole careers uncovering the why. Why did a stock drop? Was it poor leadership? Supply chain issues?
But Simons just stopped caring.
He completely ignored fundamental analysis. He didn't care what a company manufactured. He only looked at statistical probabilities. If the market closes positive on Friday and Monday, but always aggressively sells off on Tuesday morning.
He didn't send analysts to figure out the macroeconomic reason for the Tuesday sell-off. He just traded the pattern.
Exactly. He called it a statistical edge.
Yeah.
You just need an observable sequence that repeats frequently enough to be profitable.
It's exactly like having a partner. You know, you don't need to psychoanalyze their deep childhood trauma to know that if they sigh heavily and say whatever on a Friday night, you are getting yelled at on Saturday morning.
That is a perfect analogy.
You don't ask why, you just learn the pattern and prepare to dodge the flying plates. The root cause is totally secondary.
That is the exact mechanism of quantitative predictive modeling. Identify the sequence, ensure your survival. But Simons realized that to execute this on a global scale, he needed a different kind of team.
Yeah, traditional finance bros are conditioned to search for the why. So he built the ultimate nerd army. He instituted a strict hiring rule. Absolutely no MBAs, no finance grads, and zero Wall Street veterans.
He essentially quarantined his firm from financial dogma. Instead, he recruited theoretical physicists, astronomers, cryptographers, people who deeply understood how to sift through massive data sets to find faint signals.
And he forced them to work under a completely centralized model. Usually hedge funds are super siloed, right? The U.S. equities desk hides their data from the European currency desk to fight over bonuses.
Right. But Simons eradicated those silos. Everyone fed their code into one massive central computer brain. Because of this, an equation an astronomer used to calculate planetary orbits could instantly be adapted to predict government bond prices.
Which is crazy, but it makes sense. Planetary orbits and bond yields both have cyclical signals buried in noise. The math is the same.
And as their computing power grew, they started integrating early natural language processing, or NLP. It was the equivalent of deploying 1 million interns to instantly read millions of CEO tweets and news reports.
Scoring the text for fear or greed, and executing trades in milliseconds, which eventually led to things getting absurdly detached from reality.
Oh, completely detached.
There's that one anecdote where a senior executive was making massive trades on Chrysler stock purely because the computer told him to. He didn't even know Chrysler was no longer an independent, publicly traded company.
The human operators were entirely divorced from the physical reality of the asset. They were just maintaining the machine.
It's like blindly following a GPS into a lake, except the lake is filled with money. But that detachment raises a question. How does an emotionless machine handle a catastrophic, real-world crisis?
That's the ultimate stress test.
Yeah.
And the 2008 subprime mortgage crisis provides the perfect case study. The human financial world was completely melting down.
People were panicking.
Yes. But while the rest of the world burned, Simon's Medallion Fund generated a 152% return before fees.
How does an algorithm thrive in a meltdown like that?
It comes down to volatility. When humans panic, they act irrationally. Bid-asks spreads widen, and historical correlations break down. But the algorithms don't feel fear.
They just feed on the panic.
Right. They register those widened gaps as massive profit margins. They provide liquidity at extreme prices, and they don't even need to be right all the time. They only operated on a 51% win rate.
Wait, really? Just 51%?
Yeah, it's the law of large numbers. By spreading risk across thousands of global assets and trading millions of times, that microscopic edge turns extreme volatility into massive, guaranteed profit.
Because it was basically a money printer, the fees were insane. A standard fund charges 2% management and 20% profit. Simon's charged a staggering 5% management and 44% of the profit.
Nearly half the winnings.
And people still begged him to take their money because even after those brutal fees, the net return was still around 39% annually. It crushed the S&P 500. Eventually, it just became a private fund for his employees.
But that level of wealth extraction naturally invites a major ethical debate.
Right. Does this massive high-speed machine actually create value for the real-world economy? Or is it just a high-tech vacuum cleaner siphoning pennies from everyday retail investors?
It's fiercely debated. Critics argue it produces no real-world products. They say it just exploits tiny price gaps, latency arbitrage, and creates a closed loop of wealth extraction with zero benefit to the actual companies.
But the economists disagree, right? They impartially point out the flip side.
Yes, economists argue these machines provide essential massive market liquidity. Because they instantly close pricing anomalies, they ensure global assets reflect their true fair value much faster.
Which supposedly lowers transaction costs for everyone in the long run. Regardless of which side you're on, Simon's clearly hacked capitalism. He won the game.
So what does a person do with that kind of infinite wealth? You'd expect him to buy a Premier League team or launch rockets to Mars like Silicon Valley billionaires. But at 71, he retired from the fund to just do basic math homework.
Yeah, he stepped away to stand at a chalkboard. And he and his wife donated over $6 billion to academia.
Heavily funding public school math teachers and massive autism research, which actually led to the discovery of hundreds of specific genes linked to the condition.
All driven by his belief in basic research, right? Pursuing the truth of nature without caring if it has immediate business value.
Exactly. And the ultimate vindication of that is the Chern-Simons theory. Decades before he traded stocks, as a young man, he co-authored this highly abstract mathematical framework.
And at the time, it was just totally useless math on paper. It had no real-world application.
None. But decades later, theoretical physicists realized that exact math was the foundational framework for string theory. And today, it's deeply integrated into modern quantum computing.
It's just a staggering life cycle. He didn't view himself as a Wall Street titan. He was just a math nerd who accidentally solved the equation for human greed, took the winnings, handed them out to scientists, and calmly went back to his chalkboard.
So synthesizing all these sources, what is the actual takeaway for you, the listener?
Well, the point isn't to go learn Python tomorrow and try to outcompute the supercomputers at Renaissance.
Definitely not. The real lesson here is self-awareness. Simons knew he couldn't read a balance sheet or predict mass psychology, so he abandoned those games. He leaned entirely into his unique strength pattern recognition.
You have to play your own game. If you hate staring at candlestick charts and checking your phone every 5 minutes, stop playing an unwinnable game. Find the arena where you have a natural edge.
Right.
Remember, Simons, the next time you're sweating over a $20 drop in your portfolio, he built a $100 billion machine just to buy himself the free time to do math homework in his 70s. So stop aggressively rubbing your phone screen hoping for luck and go find the basic research that gives your own life meaning.
That's the personal takeaway. But the sources also leave us with a pretty chilling thought to mull over. If Simons and his army of scientists proved decades ago that the market is just a giant code waiting to be cracked by computers.
What happens to us now?
Exactly. We are in an era where AI is advancing exponentially. Algorithms are reading global market sentiment, analyzing satellite imagery, and executing millions of trades in the blink of an eye.
So, are human retail investors basically playing a children's board game while the machines play 4D chess with the global economy?
Will there even be a place for the human investor in the future?
It's something to think about. Next time you wake up on a Monday morning and stare at that glowing red screen, you might want to ask yourself, who are you really playing against?